that is not redeemable. Meaning you can't just go to the Fed's window or to the Federal Reserve Bank of whatever and say, I have $20,000, give me an ounce of gold. Obviously, it will not be that way. $20,000 an ounce will be the statutory rate, and the market rate will have to be much higher because the amount of dollars you are willing to spend to get gold in your hand, as opposed to a theoretical amount of gold that you can never get, is going to be much higher. Right now, it's about a factor of 57.3, I think it was. I did the math correctly. Why? Because gold statutorily is still $42.22 an ounce, but gold, an ounce of gold in your hand, costs about $2,500. So if you take $20,000 and you multiply it by that factor of 57 point whatever it is, gold
Welcome to Economy Express, your go-to destination for all things economics and finance. Whether you're an experienced investor, an inquisitive student, or just someone who wants to stay ahead in today's ever-changing economic landscape, you've come to the right place. Now, let's get into the details of our news.
Good evening and welcome to Economic Express YouTube channel. My name is Eric. Our top story delves into the potential revaluation of gold, with forecasts suggesting a staggering $20,000 per ounce. This seismic shift could have far-reaching consequences for our economy, notably impacting consumer price inflation and reshuffling purchasing power from dollar holders to those invested in gold. At the heart of this discussion lies a fundamental economic principle: the distinction between gold as real money and the dollar as a derivative thereof. Should this revaluation occur, it would fundamentally alter economic dynamics, exerting considerable influence over prices and purchasing power. Consider the ripple effects of such a monumental change. A $20,000 per ounce gold valuation would trigger substantial consumer price inflation. The influx of more dollars chasing the same goods would undoubtedly drive prices upward, reshaping our economic landscape. Yet, it's essential to distinguish between the statutory rate and the market rate. While the statutory rate may stand at $20,000, it's the market rate that truly reflects the value of gold. Currently, with gold's statutory price languishing at $422 per ounce, while its market value hovers around $2,500, we're witnessing a significant disconnect. Historical precedents, such as FDR's gold revaluation in the 1930s, offer valuable insights into the potential ramifications of such a move. Back then, shifting purchasing power from the public to the government through increased gold reserves was a pivotal maneuver. This revaluation would herald a seismic shift in purchasing power, transferring it from dollar holders to gold holders, effectively reversing inflationary pressures and restoring equilibrium. Furthermore, our analysis reveals intriguing trends in commodity pricing. While commodities like cocoa, orange juice, and coffee have surged in dollar terms, their stability, or even decline in gold terms, underscores gold's reliability amidst volatile dollar fluctuations. In essence, while consumer prices may surge in dollar terms, their stability in gold terms underscores gold's enduring role as a reliable measure of value. That wraps up our economic update for tonight. Stay tuned for further developments as we navigate these transformative economic waters. Thank you for joining us.
Disturbs price signals, which shifts power into the hands of dollar holders by giving them more purchasing power and screwing up the economic signals all over the place. I got a phone call and I forgot what I was saying, but I think it was about the shift in purchasing power. If gold is money and the dollar is just a derivative, then the shift in purchasing power has to happen if there is a gold revaluation to $20,000. That is what devaluing the dollar really is. When you have a country in a currency crisis, right? Let's say like Egypt was just in a few weeks ago, or maybe a month or two ago, and they devalued the Egyptian pound versus the dollar. Why did they devalue versus the dollar? Because the Egyptian pound, like every other currency in the world, is a dollar derivative. So the question is, when you have to devalue dollars, what do you devalue them against? You can't devalue them against other currencies because other currencies are derivatives of the dollar on top of the dollar in the pyramid, in Exter's pyramid. So what is below the dollar? I say this again and again, it is gold itself. The only way you can revalue or devalue the dollar, it has to be against gold, because gold is the money and the dollar is the derivative, which is exactly what FDR did in 1933, 1934. He devalued the dollar from $21 to $35 an ounce, really from 1/21th of an ounce of gold to 1/35th of an ounce of gold. And that shifted purchasing power from people to the government, right? It gave the government that purchasing power, which was only possible. That shift in purchasing power from the people to the government was only possible if the people had to give up their gold before that devaluation took place. Otherwise, there would be no shift in purchasing power, because the gold holders and the people would have an increase in purchasing power commensurate to the increase in purchasing power of the government, which would revalue their own gold supply. But if purchasing power increases for everyone, then purchasing power increases for nobody. The whole idea is that the government gets more purchasing power and people get less purchasing power, and therefore prices increase, price inflation gets worse, and you have a shift of wealth from the people to the government, and it makes everything worse. And now I'm going to show you a whole series of charts now that prove in Chartland why or how gold is really money and the dollar is not, and therefore a gold revaluation will shift purchasing power from dollar holders to gold holders, and this is proof. First chart I want to show you that shows that gold is money and the dollar is not is this cocoa from 1970 to today. We're going to go through a lot of charts here. So here's the beginning. We all think, or we all have heard, that cocoa is in a parabola. In dollar terms, it definitely is. But the problem here is the dollar more than cocoa. Are there cocoa issues with supply and harvest or whatever, distribution? Who knows? I don't really understand the cocoa market. It is what it is. And yeah, there are probably some issues, which is why the price is going up. And you'll see here, the price here in the black line on the top here is in dollars. And yes, it's in a parabola. And in the blue line, since the 1970s, yeah, we have a little bit of a parabola here from about 1.8 ounces to now 3.76 ounces. So yeah, it looks like the price has doubled in terms of gold, which is pretty rare. But the problem is really in the dollar and not gold. And in gold terms, cocoa is very cheap, cheaper than it was throughout the 1970s, 1980s, even most of the 1990s and early 2000s. We'll keep going here with the next tab, and that's orange juice. Orange juice is also in a parabola. Orange juice is getting more and more expensive at record highs in dollar terms. You can see the black line at the top here, and on the bottom you have 1970 until today, and the amount of gold ounces it costs to buy the same unit of orange juice has gone down from about 1.6 gold ounces to 0.16. So we have fallen by an order of magnitude in gold terms. Now, the point I'm trying to make here as we go through the next charts is that these prices